Hello, and welcome to the WashU investment firm presentation for the CQA challenge. Today, I am here. My name is Matthew with my teammates, Harry, Alan, and WashU, and we're going to begin with WashU describing our philosophy for the challenge.
Okay, thank you for your introduction. Let me talk about our philosophy and the process to construct the portfolio. Our purpose in the whole process is to maximize the Sharpe ratio and reduce the volatility of the portfolio. We believe that macroeconomic would have huge effect on the financial market, especially for this year. The consequence of presidential election could influence several industries, like energy, high tech, and medical care. So we hope to diversify the portfolio as much as possible and reduce the beta to zero. And for valuing stocks, we decided to use quantitative analysis. Our selection mainly depends on the multiple factors model. It uses a series of factors as the condition to select stocks. We believe that return of stocks is consistent with different factors, and our goal is to find and weight them. Well, before constructing the whole portfolio, we analyzed the risk sources. During this period, we did research about several industries and some financial reports of corporates with huge market value. There are many factors that affect the return of stocks, and most of them are related with each other. So we need to separate them and left those which are independent. Here, we use the principal component analysis and LASSO model to mine out the important factors and eliminate those trivial components. After that, we use the linear regression to decide the weight of them and rank the stocks by this model. The construction of our portfolio is based on that. Okay, let me teammate Harry Liu to introduce our portfolio in detail.
Thank you, Haosu. Although we have developed a robust factor model on selecting stocks, there are still trading constraints and limitations on how we could select those names. In terms of trading and rebalancing, there are three major parts: strategy rebalancing, constraints on user rebalancing, and factor rebalancing. We first focus on the strategy rebalancing, which might take more trades than others, as shown in the graph. These will include change of structures, major factors, including beta or market sensitivity. The next focus will be factor rebalancing, where we check out the Axioma reports every time and see if the portfolio is representing our intended factors and decision. Lastly, on a weekly basis, we'll rebalance the portfolio so that it is within the trading constraints of the competition. Next, to better explain our decisions at the balancing points, I would love to integrate the risk and return expectations on the portfolio. Due to the constraints on the portfolio, we believe that the largest factor that might affect the portfolio's performance is the market sensitivity or the beta of the portfolio. We predict that the market will go higher due to competition period due to Biden's stimulus package in November. So we aim for a positive beta for the portfolio, but we ended up with a negative beta of 0.12 because we shorted too many high volatility or high beta stocks in the beginning, as shown on the volatility graph. This goes against our initial expectation, so we changed the market sensitivity factor and volatility factor significantly in the first strategy rebalancing. This change makes the portfolio align with our expectation on risks and potential return in the largest factor. Also, the other two factors we focus on is growth and medium-term momentum factor. We believe that 2020 was a year where growth factors outperformed value stocks. So we put increasing portfolio weights and exposure to growth factor. At the same time, since most of the stocks have been performing very well in medium term, our exposure to momentum factor becomes inherently huge, and that translates into unexpected risk exposures in that factor. This might be a potential reason why we're not flexible enough when the market went down a lot in 2021 and we took much unnecessary loss. In the future, we'll be more careful in looking at risk factors and adjust our positions accordingly. Next, I will let Alan talk about the portfolio performance.
Thank you, Harry. Our portfolio underperformed the market 0% return by returning a nearly 7% loss during the trading period. The losses were largely a result of our short positions. Positions in the technology sector comprised the largest share of our portfolio's weight, surpassing any other industry's weight by over 10%. The sector also peaked at a fifth of our portfolio's composition before dropping to around 13%. It is also worth mentioning that the semiconductor industry was the best performer of the technological sector. We also shorted the healthcare sector throughout most of the competition. It initially underperformed, but rapid declines during the end of the competition made it the top performer for the time period. Shorts in biotechnology companies would also end up being the best performing industry in our portfolio. Shorts in the industrial sector negatively affected performance throughout most of the trading period. They would eventually go on to recover near the end of the period. Overall, shorts in the consumer discretionary sector will go on to become the most damaging to the portfolio, with shorts in the energy sector and materials sector falling closely behind. In the chart to the right, you can see our top performers. Bilibili, a Chinese video sharing company, would go on to produce the largest individual impact on our portfolio, with a contribution of around 1.5% and a return of 141.38% throughout the competition. Also, 3D Systems, a manufacturer of 3D printers and scanners, would end up being our largest loser. They contributed to our portfolio, they contributed roughly a 1% negative return to our portfolio and returned a negative 192.27%. I will now pass you on to Matt to tell you about our portfolio attributions.
Thanks, Alan. So in conclusion, we wanted to look at the attribution for the portfolio. You can see here on this graph that in general, over the course of the competition, the S&P 500 increased. This made, because of the CQA challenge restrictions, we had to have an even exposure on the long side and the short side. So it made it difficult to maintain gains on the short side. In this graph, you can see that we had a higher overall risk than the CQA index, and our largest contribution of risk was within style risk on the factor active side. Also here you can see throughout the entire competition, style factors were our largest contributor to active risk, even more so than industry, market, and factor covariance. And lastly, you can see the largest contributors to our active return by style. Specifically, liquidity was our highest positive contributor, and size was our largest negative contributor to overall risk, almost throughout the entire challenge from beginning to end. Here are our references. Thank you for watching, and thank you for allowing us to contribute to this challenge. Thank you.